Hello friends, the subject for the day is Indian financial system. In that subject, today we shall study the topic of insurance. It will cover principles of insurance, types of policies, major insurance rules, history and regulation of insurance companies, and role of insurance in economic development. Friends, let's have a look at the introduction of this topic. Insurance simply means to provide for a future financial loss. When we talk about financial services, insurance is one such service which helps the investor in risk management by providing a hedge against some contingent loss. In case of an insurance contract, an entity which provides insurance is known as an insurer or an insurance company or insurance carrier. A person or a body who buys insurance is known as an insured or a policy holder. Here, the insurer is supposed to assume a contingent loss. The insurer receives small payments by the insured and in turn he promises to pay in case the loss happens. The loss may or may not be financial, but it must be reducible to financial terms and must involve something in which the insured has an insurable interest established by ownership, possession or pre-existing relationship. The contract received by the insured is called the insurance policy. It mentions all the conditions and circumstances under which the insured will be financially compensated. The amount of money charged by the insurer to the insured for the coverage set forth in the insurance policy is called the premium. Every family depends on the leader every day for financial support. Food, shelter, transportation, education and much more. Spouses have plans for their future and dreams for their family. Another child, a bigger home, a new business, college education, travel, retirement and whatnot. Insurance is all about ensuring that one's family has adequate financial resources to make those plans and dreams come true in the event of his premature death. And just as his spouse and children as beneficiaries count on him, he counts on his spouse. This is especially true today with so many double income families. Friends, let's understand the principles of insurance. Number 1. Proximate cause. It is the main cause which brings about a loss with no other intervening cause which breaks the chain of events causa proxima. Number 2. Insurable interest. To insure anything, the insured must have an insurable interest in the subject matter of insurance, that is, he must benefit by its safety or be prejudiced by its loss. Insurable interest may be created either by number 1, obligation to insure, which comes by A. statute, B. by contract and C. by custom. Number 2, option to insure, which comes by A. owners, B. mortgagors, C. lessor, D. trustees or E. tenants. Number 3, contribution. Although the insured may effect more than one policy to cover the same property or interest, he or she cannot recover in total more than a full indemnity. Cover can only arise when the policies A. Cover the same peril, B. Cover the same subject matter, or C. Are affected by or on behalf of the same insured. Number 4. Indemnity. It is the placing of the insured in the same financial position after a loss as he or she was immediately before the loss. In the event of a claim, the insured must A. Prove that he or she has sustained a monetary loss, or B. Prove the extent and value of his or her loss. C. Transfer any rights which he or she may have for recovery from another source to the insurer if he or she has been fully indemnified. The settlement of the loss will be subject to the limitations mentioned here. A. Sum insured, B. Average, C. Excess or deductible. Number 5. Utmost good faith. It is the duty to disclose all material facts relating to the risk to be covered. A material fact is a fact which would influence the mind of a prudent underwriter in deciding whether to accept a risk for insurance and on what terms. Duty of disclosure applies to both the proposer and the insurer. Duty of disclosure operates at A. Inception, until the date cover is confirmed by the insurers, B. Renewal up to the renewal date, C. Mid-term alterations until the insurers confirm cover in respect of the alterations. Number 6. Subrogation, which means stepping into the shoes. It is the right of an insurance company who has paid a claim to its client to pursue another party who may have caused the incident resulting into the claim. Friends, it is important to know that the insurer must exercise the right of recovery in the name of the insured, which prevents the insured from obtaining more than one indemnity. Subrogation rights only apply where there is a legal liability under the policy, that is, where the policy cover existed. Friends, let us understand the various types of policies. Number 1. Endowment policy. It covers a risk for a specified period, at the end of which the sum assured is paid back to the policyholder along with the bonus accumulated during the term of the policy. It is this feature, the payment of endowment to the policyholder when the policy's term is complete, that rightly accounts for the popularity of endowment policies. Typically, as one's children grow up and get independently settled, his responsibility to protect the family financially reduces significantly. The focus now shifts to managing a smaller family, perhaps only oneself and his or her spouse after retirement. This is where the endowment, the original sum assured and the accumulated bonus received comes in handy. One can either use the endowment amount to buy an annuity policy to generate a monthly pension for the rest of his life, or put it into any other suitable investment of his choice. This is the major benefit that an endowment policy offers over a whole life one. Number 2. Whole life policy. A typical whole life policy runs as long as the policyholder is alive. In other words, risk is covered for the entire life of the policyholder, which is why such policies are known as whole life policies. The whole life policy monies and bonus are payable only to the nominee of the beneficiary upon the death of the policyholder. The policyholder is not entitled to any money during his or her own lifetime. Number 3. Term life policy. Term life policies cover risk only during the selected term period. If the policyholder survives the term, the risk cover comes to an end. A term plan is designed to meet the needs of people who are initially unable to pay the larger premium required for a whole life or an endowment assurance policy, but hope to be able to pay for such a policy in the near future. Hence, they may leave the final decision regarding the plan to a later date when a better choice can be made. No surrender, loan or paid up values are granted under these policies because reserves are not accumulated. If the premium is not paid within the grace period, the policy will lapse without acquiring any paid up value. However, a lapsed policy may be reviewed during the lifetime of the life assured, but before the expiry of the period of 2 years from the due date of the first unpaid premium on the usual terms. Accident or disability benefits are not granted on policies under the term plan. Number 4. Money back policies. Unlike ordinary endowment insurance plans where the survival benefits are payable only at the endowment period, money back policies provide for the periodic payments of partial survival benefits during the term of the policy as long as the policyholder is alive. An important feature of this type of policies is that in the event of death at any time within the policy term, the death claim comprises the full sum assured without deduction of any of the survival benefit amounts which may have already been paid as money back components. Similarly, the bonus is also calculated on the full sum assured. Number 5. Joint life policies. These are similar to endowment policies in that they too offer maturity benefits to the policyholders apart from covering risks like all life insurance policies. But joint life policies are categorized separately as they cover 2 lives simultaneously. It is thus offering a unique advantage in some cases, notably for a married couple or for partners in a business firm. Friends, let's understand the major insurance roles. The underwriter. He is employed by insurance companies to assess the risk and dictate the terms of the policy, including the premium. The surveyor. He is contracted by the insurer to act as an intermediary between the insurance company and the policyholder over claims. The loss adjuster's role is to help settle the claim fairly and speedily. The broker. He is an independent intermediary who uses his knowledge and experience to assess the client's risk and find appropriate policies. The claims advisor. They are the members of an insurance company's claim department. They are the first port of call when a claim comes in. The actuary. They provide the formula which is used to calculate premiums and surrender values. They have the legal responsibility of certifying that the millions invested in life insurance policies are safe. The financial advisor. Most companies offer investment opportunities to clients. They are appointed by the firm so as to discover customer needs and offer policies accordingly. Friends, let's understand the history of insurance business in India. The life insurance business started in India in 1818 with the establishment of the Oriental Life Insurance Company in Kolkata. Some of the important milestones in the life insurance business in India are given here. In 1912, the Indian Life Assurance Companies Act was enacted as the first statute to regulate the life insurance business. In 1928, the Indian Insurance Companies Act enabled the government to collect statistical information about both life and non-life insurance business. In 1938, earlier legislation was consolidated and amended by the Insurance Act with the objective of protecting the interest of the insuring the public. In 1956, 245 Indian and foreign insurers and provident fund societies were taken over by the central government and nationalized. LIC was formed under the Act of Parliament. The general insurance business in India dates back to 1907. Friends, let's understand what are the regulations of insurance companies. This millennium has seen insurance come a full circle in a journey extending to nearly 200 years. The process of reopening of the sector had begun in the early 1990s, and the last decade and more has seen it being opened up substantially. In 1993, the government set up a committee under the chairmanship of R.N. Malhotra, former governor of RBI, to propose recommendations for reforms in the insurance sector. The objective was to complement the reforms initiated in the financial sector. The committee submitted its report in 1994, wherein, among other things, it recommended that the private sector be permitted to enter the insurance industry. They stated that foreign companies be allowed to enter by floating Indian companies, preferably a joint venture with Indian partners. Following the recommendations of the Malhotra Committee report in 1999, the Insurance Regulatory and Development Authority IRDA was constituted as an autonomous body to regulate and develop the insurance industry. The IRDA was incorporated as a statutory body in April 2000. The key objectives of the IRDA include promotion of competition so as to enhance customer satisfaction through increased customer choice and lower premiums while ensuring the financial security of the insurance market. The IRDA opened up the market in August 2000 with the invitation for application for registrations. Foreign companies were allowed ownership of up to 26%. The authority has the power to frame regulations under Section 114A of the Insurance Act 1938 and has from 2000 onwards framed various regulations ranging from registration of companies for carrying on insurance business to protection of policyholders' interests. In December 2000, the subsidiaries of the General Insurance Corporation of India were restructured as independent companies, and at the same time GIC was converted into a national reinsurer. The Parliament passed a bill delinking the 4 subsidiaries from GIC in July 2002. Today, there are 31 general insurance companies, including the ECGC and Agriculture Insurance Corporation of India, and 24 life insurance companies operating in the country. Friends, now let's understand the role of insurance in economic development. In addition to contributing to the economy by preserving human life values and assets and protecting loss, insurance also aids in economic development. To grow economy, the government needs capital to finance infrastructure, that is, roads, bridges, industrial farm communication and railway lines, which requires a huge investment. Individual or government is unable to provide such funds. As the life insurance contracts are long-term contracts, therefore, the insurer, by investing funds that flow to them from their many policy holders, have become the principal source of capital for the economy. Investments are essential ingredients for economic development of any nation. Investments by the insurance companies are in social sector, infrastructure development and government security, papers and bonds. Life insurance plays a major role in mobilization of public savings, approximately rupees 75,000 crores a year. Savings out of life insurance fund are utilized in investments for growth, that is, infrastructure bonds, housing, railway, equity markets and so on. Looking to non-life side business, industry and trade would be seriously handicapped in the absence of insurance cover relating to losses due to fire, earthquake, flood, storm, natural calamities or act of God. Widespread of insurance brings in indirectly the said advantages: better living standards, higher productivity, improved law and order, higher GDP, a healthy generation. It discourages bad habits and practices causing damage to human life, higher mortality, happy society, enhanced self-esteem, creative minds, entrepreneurship qualities and social upliftment of the society as a whole. Friends, since we know that insurance is important for economic development, now we shall understand how insurance is important as an investment. In fact, life insurance companies are getting the savings of an individual for longer period. Therefore, the government has prescribed the norms how the insurance companies can invest their funds. The norms are given here. Every insurer carrying on the business of life insurance shall invest and at all times keep invested in the said manner. Number 1, 25% in government securities. Number 2, not less than 50% in government security or approved securities, including 25% in government securities. Number 3, A, not less than 15% in infrastructure and social sector, and B, not exceeding 35% in other capital market investment in other than approved investments can in no case exceed 15% of the fund. From the said norms, it will be observed that the government has asked the insurance to channel the funds to state and central government, infrastructure sectors, social sector and rural sector and capital market. Friends, let us see What benefits does the government get out of insurance business? A. Long-term funds and debt instruments are available to develop the economy. B. Infrastructure funds are available to create roads, bridges, community housing, and so on. It reduces the burden of the government. C. Investment in rural and social sector reduces the responsibility of the government, as a result of which the financial burden of the government reduces. D. Capital market. If the insurer is investing the fund in the capital market, then industry can enhance their production capacity, which will have the multiplier effect on the growth of the economy. Friends, let's summarize the session now. Insurance has become the necessity tool for our life. It not only provides security but also saving for future. At a younger age, the necessity may not be felt, but as the man grows old, it starts feeling the responsibility towards his family. The insurance also helps the economic development of the country, as government gets the huge funds at a nominal rate of interest for a longer period. Moreover, if the people are taking care for themselves about their present and future needs, then government will spend their funds in more productive manner. The insurance sector is a massive one and is growing at a speedy rate of 15 to 20%. Together with banking services, insurance services add about 7% to the country's GDP. A well-developed and evolved insurance sector is a boon for economic development, as it provides long-term funds for infrastructure development, at the same time strengthening the risk-taking ability of the country.